AI can be used by everybody, and everybody's looking into how to use it.
Influential strategist Ed Yardeni identifies the megatrends moving the U.S. economy and markets and how to profit from them.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Miller Value Partners, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of the biggest surprises of the 2020s decade so far has been the resilience of the U.S. economy. Aside from a 2-month recession in 2020 caused by government-induced shutdowns, GDP has continued to grow, and despite occasional pullbacks, the stock market has reached new highs. Now, none of this is a surprise to this week's guest, who predicted a roaring 2020 scenario 6 years ago and reiterated that forecast with us recently in the first of our 2-part interview with him. You can catch it on wealthtrack.com. He is influential strategist Ed Yardeni, head of Yardeni Research, a global investment strategy firm he launched in 2007. He is a PhD economist, strategist, and Fed watcher, widely followed by investors and the financial press, including Wealth Track. He is also the author of several books, which I have recommended on Wealth Track, including Fed Watching for Fun and Profit, a primer for investors, and In Praise of Profits. This is part 2 of our most recent interview with Yardeni, and in part 1 we discussed his now 6-year-old prediction that what he calls the roaring 2020s economy and markets will continue well into the second half of the decade. This week I asked him to explain the megatrends driving U.S. economic growth.
One of the most obvious ones that's going to continue is the technology boom that we're seeing. I read Elon Musk's biography by Walter Isaacson about a year ago, and it was fascinating because when he was a kid, he read all these science fiction books, and in his mind, this was the future. This is something that he could accomplish, and he kind of viewed that as all kind of not fiction, but nonfiction. And here we are. I mean, we really are in the future.
As far as Elon Musk is concerned.
Yeah. And, there are other futurists that are already, working on practical applications of everything that the sci-fi people were positing. For example, Jeff Bezos is talking about putting data centers in outer space.
Yes.
Because it's a more efficient use of solar energy. We're very blessed to have some amazing futurists that are spending money and are creating our future. Obviously, there's downsides and risks and all that, but all in all, the future's sort of here, and the technology to drive that is here as well, and will be increasingly here. I started talking about the digital revolution in America a while ago. I wrote a book in 2018 in which I said, one of the things economists almost always miss is the impact of technology on our economy. They see all these problems, and they don't realize that entrepreneurs see the same problems, but they see an opportunity. They see a way to solve these problems. As a matter of fact, if you go, I have Samuelson's first book on economics. When you go to study in school, Economics 101, it was typically Samuelson, a big, thick textbook. And I think he defined economics as the study of the optimal allocation of scarce resources. That is such a depressing way to think about economics. It's like, really? There's only so much out there, and we have to figure out how to distribute it. I think economics is all about technology solving the scarcity problem. When there's a scarcity, the price goes up, and some entrepreneur says, I can replace this very expensive good or service with something a lot cheaper and a lot better. And we're seeing that kind of moving into hyperspeed when it comes to things like AI. Mm-hmm. Now, the digital revolution is very important because I think it started in the mid 1960s. And the concept really is really simple. The whole idea of the digital revolution is to process as much data as we possibly can, as fast as we can, as cheaply as we can. So we went from the IBM mainframes to the digital equipment, mini computers in the 80s. Then we went to the PCs and the laptops. And then I think a big development in the digital revolution was the cloud computing, where now you didn't really have to buy software, you could rent it. You didn't have to have massive amount of storage in your location at home or in business. You could rent that as well. And now we have AI. AI I view as just a super duper application.
You and I had actually done a show a couple of years ago. I remember this wonderful piece that you wrote about artificial AI is not intelligent.
Yeah, artificial intelligence is artificial but not intelligent. And I still feel that way, but it's super fast. It's like Google search on steroids and speed. It is lightning fast, and it gives you a summary of what you're looking for, and it gives you the references. A lot of people, including myself, still don't trust it. You still have to check it. But if you want to get sort of a quick overview of things, and that's just kind of the way I'm looking at it. There's so many other applications for artificial intelligence. When you think about Microsoft Office, it really had only two applications, and that was Excel and Word. And once you replaced a lot of secretaries on selectric typewriters with Word, and once you replaced a lot of bookkeepers with Excel, that was kind of it. And it didn't have widespread applications to all businesses. AI can be used by everybody, and everybody's looking into how to use it. And what you know today about AI will it be different 6 months from now? Only
so
a couple of months.
It's moving that fast still.
Yeah, it's unbelievable. Only
Right.
a few months ago, the center of the universe was OpenAI, a private company that was doing all these deals with NVIDIA and SoftBank, and that was sort of the center of the universe. And Google was just kind of like dragging along. And suddenly Google said, well, actually, we've got something called Gemini 3, which is much better than ChatGPT. The chips we run it on, they call them TPU chips, run cooler, and they're cheaper than the GPU chips that NVIDIA has. And NVIDIA comes back and says, yeah, but ours are much more high powered for more applications. But the point is the revolution continues, and there will be a lot of developments within it.
Lots of competition, lots of innovation, lots of new applications. I think you told me that the increase in applications is kind of exponential.
It's exponential.
Yeah.
And with AI, you can create even more. And it does work in a lot of applications.
So that's one mega trend, the digital revolution, which again is just going faster than the speed of light in a lot of respects. How does one invest with that? What's the best approach that we should take as investors?
It's just got a little trickier, right? Because even until recently, you just invested in the Magnificent Seven.
Yes,
they
right.
were doing all the AI technology, and it kind of worked. But now you've got to be a little bit more selective. I think it's just going to be a horse race that goes on and on and on. And I think you just take a portfolio and take some mix of them. And then I think you also have to invest in the, as I said, not just the Magnificent Seven, but the impressive 493, the other members of the S&P 500. So if there's 7 that are really magnificent, what about the remaining 493? Those are the companies that are going to be using all this technology to increase their productivity. In some ways, all these companies are becoming technology companies. They all have to use technology to do what they're doing.
Is there any such thing as too much data? With all of the multiplication of applications, is there a point where it just reaches a saturation point? It's not going to increase productivity.
Very important point, and I would take it, and I've actually been saying exactly the opposite, in the sense that the more data we can process, the more cheaply we can do it, the faster we can do it, the more data we're going to process. And there'll never, ever be a shortage of data. We're always going to find more data. And there's going to be payoffs for being able to analyze it at the speed of light.
You really see it as just kind of this golden universe of progress.
Let me quote the great astronaut Buzz Lightyear.
Toy Story.
But Buzz Lightyear said to infinity and beyond. It's a strange story where, there is no shortage of supply of data. There's always going to be more and more as we get into autonomous driving, humanoid robotics, just an explosion of data. And the more we have, the more we want to be able to process it faster and cheaper.
Another theme that you have been tracking for a long time is demographics. So talk to us about the demographics that you are watching, and tell us, why it's important, and again, what the investment implications are.
That was one of the reasons that I got it right over the past few years, that there wouldn't be a recession. The consumer has to keep spending or else you get a recession. I mean, clearly they account for 75% of the economy.
Right, U.S.
And
economy.
I've been watching the baby boomers because I'm a baby boomer. Early in my career, I thought I was really special and unique and wonderful. And then I realized there's 75 million other people like me, kind of going through the exact same life stages in their lives. That's changed. We got a different kind of demographics now. But the baby boomers still are having an impact in terms of they're starting to retire, and they're retiring with a huge nest egg of $80 trillion in net worth. And I think the savings rate in the country is going to go negative, because if you have all these people that are not working, are living it up, going out to meals.
Right, that's great short term for the economy, right? But long term?
Long term, they'll pass away, and they'll pass lots of that money to the next generation. And meanwhile, the next generation is already accumulating some net worth.
Speaking of an important demographic trend, looking at the baby boomers and the wealth that they've accumulated, and how stimulative that is to the economy, their spending. What happens as they die off? And what about the successive generations? What shape are they in? Will they have the wherewithal and the jobs and the income to basically continue to fuel this wonderful U.S. economy?
That's a hard question to answer. I mean, clearly you can come up with reasons to believe that the next generation should do fine, and other reasons that they're not going to do so well. I mean, right now we know that kids coming out of college are finding it very hard to find jobs. The unemployment rate for 20 to 24-year-olds has zoomed up from about 5% to 9% just over the past year. That's very troubling, and the baby boomers are helping their younger children, even as adults, dealing with the affordability crisis, which is it's a real story out there. But I would say, on the plus side, a lot of the younger Americans are going to be getting some sizable inheritances that have never occurred before in America. I mean, it's the wealthiest generation ever, and they're not going to be able to spend it all, and they already are starting to pass it along.
Another mega trend is sovereign debt. And the debt levels in this country as a percentage of GDP are near World War II, if not beyond levels, and we're not at war. And there are debt levels as well in other developed countries, UK, Japan. I mean, China has large debt levels too. When you track that, what impact do you think that is going to have on economic growth and also, again, on our investment strategy?
The sovereign debt problem is clearly an issue as we look into the future. And now we are seeing the possible debt crises in countries like Japan and the United Kingdom. And the question is, how long before we have a debt crisis here in the United States? I think that's something I'm concerned about. I try to stay informed about it, but I will worry about it when the bond market worries about it. As long as bond yields are staying down, I think we're okay. But if the bond market starts to show what's going on, like what's going on in Japan, then I think it'll be a real concern here. But meanwhile, the fact of the matter is there's still lots of demand for our securities. This recent development with stablecoin, it's a cryptocurrency that will be backed by treasuries. That creates even more demand for U.S. debt. So we've kind of gotten away with this for quite some time. In some ways, it's like stealing from our children. We're leaving them all this debt because we don't want to raise taxes. We don't want to lower our entitlements.
And no end in sight to that until they are in charge of our political process, and that is a very slow transition to a younger generation at this point.
I don't think this is a down the road issue anymore politically. I think it's really a problem for the midterm elections for the Republicans, because young people are going to be looking at their lives and say, did the Republicans really help me or not?
That will be very interesting to watch. Another topic that I want to bring up that's near and dear to your heart is the Fed. And you worked for the Fed early on in your career. You're a PhD economist. And you have also written a fun book that you and I discussed at length at another program that will be available on wealthtrack.com called Fed Watching for Fun and Profit. So there's this famous adage, which is don't fight the Fed. Is that still the case? And will the Fed, which has had a tremendous influence on the economy and markets for years now, is that influence changing at all?
Consuelo, this is a very emotional topic for me. I wish you hadn't brought it up because for the past few years, every now and then I've written that I'll do what the Fed does for half the price, as long as they let me do it from home. I think me and my staff could probably come up with something kind of similar to what they've been doing with their big staffs, but they haven't taken me up on my offer. I'm just disappointed I didn't show up on their short list of Fed candidates, but then again, I've been opposed to the idea of the Fed lowering interest rates. For example, in 2024, when the Fed lowered the Fed funds rate by 100 basis points, I said, it's not a smart thing to do because the economy is doing well, inflation isn't down to 2% yet, and beware of the bond vigilantes, beware of what happens in the bond market. Mm-hmm. And sure enough, bond yields went up 100 basis points.
So the Fed's influence, does it remain as powerful as it's been?
I think the Fed remains powerful. It's part of investing these days. It certainly has an impact on the macroeconomic environment that influences the market. It certainly has an impact on short-term volatility in the market. I'm trying to decide whether the Fed's going to be more or less independent next year. I think we're already seeing that other Fed officials are starting to say, well, maybe we can start being even more independent than we've been in the past. Because in the past, Fed chairs just had this historical power over the other members to influence them to get a consensus. That may not be the case. So I could see a Fed chair saying, I want interest rates to go down even more. And conceivably, he could be in the minority.
Are there any other big trends that we haven't discussed, or are there any other mini trends that could turn into a mega trend that you're watching?
The geopolitical situation is unsettling, for sure. We've got the world sort of splitting up between those that are on our side and those that are on the other side. Globalization had been a huge trend that had a lot of implications for keeping inflation down. I'm not sure the globalization's over. It just seems to be getting somewhat redistributed. So instead of a lot of goods being made in China, now they're being made in Vietnam and Mexico. So I think we still have globalization.
Ed, one investment to take advantage of some of these megatrends that perhaps we should all own in a diversified portfolio?
The way to take advantage of this mega trend is to bet that the global economy overall is going to grow. Betting on emerging markets may not be a bad idea, because if the world is going to stay relatively globalized, which I think it will, you just have to bet that there are just huge populations in places like India and Africa that aspire to be middle class. That want a better lifestyle, and so I think there are opportunities to invest overseas, and you could do it with ETFs. Emerging market ETF would be one way to do it, and just kind of put some of that away.
That's a change for you, Ed, because I think since 2010 you've been pretty adamant about overweighting the U.S. by far. In 2025, we've had a change in market leadership where the foreign markets have done much better than the U.S. market. Do you think that's going to continue?
Yeah, that is a change for me. I had been promoting the idea of staying home rather than going global since 2010. It's worked like a charm until this year. This year it does not work. Look, America now accounts for 65% of the market cap of the MSCI global stock market. It's hard to recommend overweighting something that's 65%. It's already overweight. And the same thing, by the way, I've changed my tune on technology and communication services. I love the concept. I love what it's doing to our economy in terms of increasing productivity. But if you take in the S&P 500, add up the information technology sector with the communications services sector, you get that they collectively account for 45% of the market cap of the S&P 500.
Wow.
That's just not a very diversified portfolio, so that's why I've been recommending moving more to the S&P 493. I haven't really gotten turned on to the SMID caps, the small caps and the mid cap stocks, because the earnings profiles just kind of remain in a coma.
And I have one last question for you, which is another change when you and I talked a year ago, and that was you had never been a person who recommended or owned gold, and that changed a year ago, at least in 2024, if I remember correctly. What's your view now?
Well, when the price of gold went above 2,000 to a new record high in 2024, I concluded that it was obvious why I was doing that. Foreign central banks were buying gold. So I said, it's probably a bull market again. When it got to 3,000 at the beginning of this year, I looked at the charts, because I don't have any way to value gold. I don't have, there's no interest, there's no dividends, there's no coupon, nothing. So you are kind of, at some point, just kind of stuck with looking at the charts. And the charts looked to me like we could get to 4,000 by the end of this year, and here we are at 4,000.
Right.
I think it's going to consolidate for a while into the middle of next year. And then the next stop, I think, will be 5,000. There is one chart I have that provides some substance to the idea of why gold might continue to go higher. As a matter of fact, I think it could go to $10,000 per ounce by the end of the decade. And if you put the S&P 500 stock price index on the same chart as the price of gold, and you could put them on the same scale, on a logarithmic scale, what you see is that gold is actually a pretty good diversifier. It's inversely correlated on a short-term basis with the S&P 500. But on a longer-term trend basis, if I'm right in my projection that the S&P 500 could reach 10,000 by the end of the decade, then gold might be able to do the same thing.
That's absolutely fascinating, and it usually doesn't work out that way, right? I mean, they usually are non-correlated.
That's the insight, is that on a short-term basis, they are inversely correlated. A long-term basis, there may be more portfolio balancing going on a global basis, where people get richer. They said, maybe I should have some more gold.
Always fascinating to talk to you, Ed Yardeni. So thank you so much for joining us once again on Wealth Track.
Thank you.
One of the most famous and valuable expressions of Wall Street wisdom is "don't fight the Fed." As regular Wealth Track viewers know, it's a phrase coined by Martin Zweig, a legendary technical analyst and investor who predicted the 1987 market crash to the day and was the author of the 1970 investment classic, Winning on Wall Street. Zweig wrote that the monetary climate, primarily the trend in interest rates and Federal Reserve policy, is the dominant factor in determining the stock market's major direction. Well, it certainly makes sense. When the Fed raises interest rates, making money more expensive, business slows down and stocks become less attractive. Conversely, when the Fed lowers interest rates, borrowing becomes cheaper, business picks up, and stocks become more attractive. This week's guest agrees with Zweig's advice and has written his own book on the topic, Fed Watching for Fun and Profit. It's a primer for investors, which I highly recommend. I also discussed it with him at length a couple of years ago in an interview available on wealthtrack.com. For this week's action point, I asked Yardeni to recommend some other books to help us understand the Fed. This week's action point is read the autobiographies of former Fed chairs.
I like to read biographies of Fed chairs. There's a very good one, or autobiographies. So there's a very good one that Bernanke wrote. Ben Bernanke wrote about his time at the Fed. Alan Greenspan has done the same. So I would start with those two autobiographies as sort of a way to get not only an insight into Fed chairs, but also into the Fed and their impact on the economy and financial markets.
Don't fight the Fed. Timeless advice from legendary investor Marty Zweig and WealthTrack regular Ed Yardeni. Next week for our Christmas holiday weekend, we are once again sharing Ed Yardeni's bullish 2026 outlook, why he says his now 6-year-old Roaring 2020s market theme will continue. Please follow us on Facebook, X, and our YouTube channel. Thanks for giving us the gift of your time during this busy holiday season. Have a Merry Christmas holiday and make the week ahead a healthy, profitable, and productive one.